Welcome to this Wednesday edition of Inside India. I'm Sri Jegarajah. Your headlines. President Trump's telling CNBC he'll be imposing hefty tariffs on India very soon as he continues to pressure the country over Russia.
I think I'm going to raise that very substantially over the next 24 hours because they're buying Russian oil, they're fueling the war machine, and if they're going to do that, then I'm not going to be happy.
Indian farmer stocks will also be front and centre today after President Trump warned of sectoral tariffs in the coming week, with duties on pharma eventually heading as high as 250%. And we are over an hour away from the RBI rate decision. Wide expectation is for no change, but could it deliver another surprise? Asian markets, first of all, this Wednesday are looking rather patchy. On the losing end of the spectrum, TAIEX is down by 0.7%, the benchmark in Taiwan. The Nikkei, however, is up by 0.6%, 40,800. And Southeast Asia, relatively flat. The Hang Seng, similar story there, flatlining at just below 25,000. The Indian markets will be joining us in about 45 minutes' time. Gift Nifty futures are indicating a start in the region of 24,700, so that will be relatively little change from where we left off yesterday. Remember, it's going to be these tariff headwinds and the punitive tariffs on buyers of Russian oil that are going to continue to bully these markets in India as far as the benchmarks are concerned. And bear in mind as well, the rupee has been on something of a depreciation trend lately, getting rather close and perilously close to a record low, not quite getting there. 87,784 is where we stand. Remember, the RBI have been propping up the rupee, and of course we'll get that rate decision from the MPC later on today. Expectations are that the RBI will be on hold. Now, investors are waiting for President Trump's next move on India after he told CNBC in a wide-ranging interview he's planning to move ahead with substantially higher tariffs on Indian goods very shortly, criticising the country again for its Russian oil purchases.
We do very, very little business with India because their tariffs are so high. So India has not been a good trading partner because they do a lot of business with us, but we don't do business with them. So right. We settled on 25%, but I think I'm going to raise that very substantially over the next 24 hours because they're buying Russian oil, they're fueling the war machine, and if they're going to do that, then I'm not going to be happy.
All of this is further complicating things for the Reserve Bank of India, which will be out with its policy decision later today in about 1.5 hours' time, 12:30 Singapore, Hong Kong time. Economists expect no change to the repo rate. This comes after the RBI's surprise jumbo 50 basis point cut in June, bringing the benchmark repo rate to 5.5% and shifted down its policy stance to neutral. Central Bank has already lowered rates by 100 basis points so far this year. And while the wide expectation is for a pause this round, there are a few, including SBI and ANZ, who think that we could see a 25 basis point cut today, given all the global headwinds surrounding tariffs. Let's bring in Sumita Dora now, former Labour Secretary of India. She is also former Indian Economic Councillor in Beijing. Ma'am, welcome to the programme. Let's start with the trade picture, and it's quite extraordinary. President Trump says he's nearing a trade deal with China. A few months ago, it looked like India was in the front of the queue for a trade deal. Are the United States and India effectively now in an all-out trade war?
I wouldn't say that. You see, we have a comprehensive global strategic partnership with the U.S. We've had close ties and shared interests, and this goes back to, a very old relationship. We have well-entrenched trade and services relationship. A lot of our Indian students go and study in the U.S. and spend something like $25 billion every year on education and other expenses. Similarly, there are a lot of American companies in India. They are getting a lot of revenues. We have Amazon, Google, Meta, Microsoft. All these companies, they get good revenues in the country. There are also pharma and auto companies from US which get royalties on technology transfer. They get licensing fees. They produce in India. Similarly, Indian trade with the US is well entrenched. It is our largest export market. And as you are aware, smartphones, pharmaceuticals, gems and jewelry, very important market for India. With these kind of interests and these kind of ties, and we also see that in the last 1 year, trade has grown between India and US. It has grown on both sides. So when we take the total picture, trade and services, while India does have a surplus, but when we look at the larger picture, the complete ledger, where the US companies are also getting revenues, they are getting royalties, license fees, subscriptions, and so on and so forth, we do see a surplus for the US economy. With these kind of well-entrenched interests on both sides, it's been a win-win relationship all these years. And as the negotiations progress, we see the relationship getting positive. We should look at each other's strengths, and the negotiations are very much on. We are expecting another physical meeting later in August this year, the sixth round of the trade talks, and we are hoping for positive outcomes.
So you're optimistic, and we can still hope, maybe, ma'am, of a US-India trade deal by Diwali. But in the meantime, President Trump, as we said in the headlines to our program, has been warning and threatening sectoral tariffs in the coming week on pharma, with tariffs heading as high as 250%. Doesn't that put India's top export sector to the US in clear jeopardy?
You see, our total exports to US are about $87 billion. This is the merchandise trade. Plus, we have the trade in services. Our services sector is very strong. And as you will see in the news today, it has hit an 11-month high in the month of July. We also, have the global capability centers where a lot of American multinationals are invested in India, and the global capability centers are adding to the value of the American companies. So in this context, where we are doing, good trade with US, and US is an important market for us. At the same time, we also look at the many other options with the Indian economy. We are a domestic demand-driven economy. We have a resilient domestic demand. At the same time, the festival season is coming up. We also are looking forward to higher consumption happening. We are also a young demography. Our young people are they are migrants, international migrants who go work in other countries. We have higher remittances. Our remittances are at a historic high of $136 billion in this last year. Plus, we have other trading partners. And when we look at our exports to the top 10 countries, about 53% of our exports are going to the top 10 countries. US, about 18 to 19%. So there is trade diversification, and there are possibilities of greater trade diversification happening, particularly with the FTAs. We have recently concluded with UK. We are on the verge of concluding with the EU. EU is, while US is the single largest market for us, EU as a group is a very big market. We have the African demography, we have the Asian countries, and so on and so forth.
And the GCC, the Gulf countries as well. Ma'am, I do want to broach this subject of diversification in a short while, but in the meantime, if you believe that US-India relationships have not necessarily been irreparably damaged by the events of the last 1 week or so, then how, in your opinion, exactly can a US-India trade deal be salvaged?
You see, there are negotiators doing that job, and we have a strong leadership So it's really not for me to step in there or suggest anything. But having given a background of a very strong relationship in trade and economy strategically and with investments into each other's countries and the people-to-people exchange and the Indian, diaspora doing really well in US and contributing to the economy, I don't see anything which is not going to be, positive and mutually beneficial. We are looking for a fair deal which is mutually beneficial, and I'm sure our negotiators will do a great job.
Ma'am, specifically, how do you think the negotiators that you mentioned are going to overcome the roadblock that is agriculture and market access to agriculture? From the Indian perspective, this is a red line. That's abundantly clear.
Right. Yes, agriculture is a sensitive area for us, and the livelihoods, about 60% Indians depend on agriculture. Agriculture is a very important growth driver for the Indian economy, and that is a sensitive area. But there are many other strengths of the Indian economy, and we have to look at the trade deals which India has done with UK, for example, to guide us. We also have to look at the trade deals done by the other countries, by EU and other countries with US, and I'm sure all these will give us cues going ahead. At the same time, like I said, we also have to be strengthening our own economy, the resilience of our own economy.
Ma'am, just on this diversification issue, as you quite rightly pointed out, UK-India deal has been secured. EU-India is still under negotiations. Would India be better served pursuing trade deals with other partners along these lines rather than the US? Or can India pursue a twin-track approach?
You see, we are going towards multilateralism when we see the economies of the world, the trade relationships. It cannot be a bipolar world. So we have to be strengthened by looking at the other geographies. This is already happening. Let me just mention a few examples. If you look at Africa, the trade with India has been rapidly rising in pharma, in the auto sector, in digital services, in textiles, for example. Similarly, gems and jewelry is one vulnerable area when it comes to US markets. It's the top one in the top three exports to US. Gems and jewelry could find alternative markets, particularly the energy-rich Middle East countries, the Central Asian countries. At the same time, gems and jewelry, the designs have a strong, market hold in US. So it's not as if people will stop buying gems and jewelry in the US. I get the sense that our designs are very attractive, but there will be some impact. There could be a significant impact in case we don't deal soon on the gems and jewelry sector. Similarly, steel will have some impact. Auto sector, a lot of it could be absorbed within the country because we are domestic demand is very high. At the same time, paradoxically, India could also get trade diversification. Like when you compare with countries like China, which have a higher tariff, there could be components in electronics, in IT services, in textiles, in auto parts. Actually, trade from US could come to India. There could be trade diversion to India. So that is where we begin. So it's a very mixed picture. We need to be analytical here.
Absolutely. And ma'am, just on a headline level, when we talk about impacts, if 25% tariff rate is going to stick, then what does that do to growth projections in the region of 6.2, 6.5% for the current fiscal? Are those numbers at risk?
I was looking at some estimates which do part the growth a bit, and it will definitely impact the production in certain sectors. You will notice that smartphones and pharmaceuticals are almost, free of the additional tariffs. So that's an area we can park for the moment. But gems and jewelry and apparel, these two areas are areas of concern. And this is where we'll have to, look at alternatives. The country is also, as I read in the newspaper, coming up with an export promotion mission to support the vulnerable sectors. We have to have an analytical view of the impact. There will be certain areas which will be highly impacted, and these are the areas we will need to support as we go forward. But on impact on GDP, yes, coming to your question, like we've already discussed, India has a lot of strengths. Our domestic demand is high. Our growth rate, we are the fastest growing major economy in the world, and IMF just a few days back has revised its given an upward revision to the GDP growth estimate to 6.4. Moody's says that India is a resilient economy and the domestic demand and services sector is very strong. At the same time, our manufacturing is picking up with the PLI scheme. Recently, we have the employment-linked incentive scheme also coming in. The Make in India, vocal for local, you would have noticed.
Yes.
Our leadership has also emphasized going in for local products, and we have a lot of strength in the local production in handicrafts. Our carpets, in fact, our carpets going to US have a very strong market standing, and we doubt if that is going to be impacted by the tariffs.
Understood. Ma'am, would you admit that these global headwinds could aggravate the structural challenges with regard to job creation in India in an environment where recently we have seen TCS lay off 12,000 people in the workforce?
Right. You see, when it comes to the job scenario, the jobs landscape in India, it's not simple. It's not that TCS lays off 12,000 people and we say there are job losses. There is a lot of impact of AI. So there are people who are being redeployed and people being reskilled. Overall job scenario in India has actually been pretty good, though there is a lot of room for more improvement. If we look at the data, whether you look at the data from the Periodic Labor Force Survey, or you look at the ILO stats, or you look at the data from RBI, or you look at the payroll data, there's an upward trend. And we see that from 2017-18 onwards, we've had almost, 20 million plus people joining the workforce every year. So that's about, 2 crore people every year joining the workforce on an average. The labor participation rate is high, the worker population rate is high. Having said all this, we also would like to see more inclusive growth. We would also like to see better quality of jobs. We do see emergence of new employment growth drivers, like I mentioned, the global capability centers, the startup ecosystem, hospitality, tourism, the gig and platform workers, so on and so forth. Now, coming to the impact of tariffs on jobs, again, it will depend on the sector which is being impacted and whether the global supply chain is able to help us diversify the exports or the domestic economy is able to absorb it. So it's not simple, but at the same time, let me assure you, India is a growing economy, and all estimates, the international estimates point towards us being the fastest growing major economy. The jobs, as I just mentioned to you, the jobs are growing, but yes, we would like the jobs to, be more, highly paid, more highly paid, and people go up in the income bracket. We would like to see that.
Ma'am, a final question. Given the balance of external and domestic risks as they apply to the labour market, as they apply to inflation and the broader economic outlook. What do you think, in your opinion, is the most prudent path that the Reserve Bank of India should adopt?
Right. Now, that's a very interesting question because we do have the meetings going on, and we have seen the inflation has come under control. And in the last year, we have seen inflation coming down. February and since February 2025, in the last 3 meetings, RBI has cut the rates and given impetus to consumption, given impetus to growth. Festival season is coming, and how the housing sector will pick up, how the consumer durables will pick up. The auto sector, we are very optimistic. Now, whether there will be a further cut or we will be at the same rate of 5.5% is to be seen. There are expectations. I heard you earlier in the program, there are expectations of a further cut. A lot would depend on how RBI looks at the overall situation, because the investor sentiment and the asset valuation of Indian assets has also to be protected and kept attractive. So it's all a trade-off, and let's see how the RBI goes forward.
Many challenges for Governor Sanjay Malhotra and the MPC this week. Ma'am, I'm very grateful for your time today and your analysis. Thank you very much. Sumita Daura there from the former Labour Secretary of India. In the meantime, Japan's trade negotiator is in the United States to get a better deal on auto tariffs. Lin joins us to tell me more. Hi, Lin.
Yeah, good morning to you, Sri. It's not so much to get a better deal, but rather to see the swift implementation of what Japanese officials thought was the deal that was reached on July the 22nd. Chief among what Akazawa-san will be pushing for is the implementation of the hard-fought and won concession when it comes to the lower auto tariffs, keeping in mind that this is a key week for autos earnings, and we'll get a better picture of how many of these automakers are dealing with the 25% tariffs coming through from the US as well. Also, there is consternation around the stacking of tariffs as well. The understanding from the Japanese side was that there wouldn't be a stacking of the so-called reciprocal tariff with other tariffs come August the 7th. There was a revised executive order that explicitly stated that the EU was exempt, but Japan was not on that document. So this could be something that Akazawa-san could be raising as well with his US counterparts. And of course, key inconsistencies in terms of understanding around the joint $550 billion investment fund. We heard from the US president. He spoke to our colleagues over in the US overnight on this. Let's take a watch.
I got a signing bonus from Japan of $550 billion. That's our money. It's our money to invest as we like. European Union, $650 billion. Think of it. And they're going to buy $750 billion worth of our energy. And they're going to do this, and they're going to do that. And by the way, they're going to open up their countries, which they've never done.
The US president basically characterizing that $550 billion as being given to the United States to invest at their will. But we have heard from Japanese officials saying that that 550 is an up to number and also includes loans, guarantees, as well as equity investments. A very different characterization on that key detail as well, Sri.
Great work, Lin. And the Japanese automakers clearly by the price action there in Tokyo trade, hoping for some carve-outs and exemptions and some tariff relief. Thank you, Lin. We'll be back in 2 minutes with news and updates from South Asia. Do stay with us. Welcome back to Inside India. Some of the stories we're keeping tabs on. Philippine President Marcos Jr. is in New Delhi on a state visit. He met with the Indian Prime Minister for talks on trade, defence and regional security. The two discussed deepening cooperation amid rising tensions in Asia. Thousands gathered in Bangladesh to mark 1 year since mass protests sparked a political overhaul and led to the ouster of Prime Minister Sheikh Hasina. Yunus-led interim government also unveiled a roadmap for democratic reform, including plans for a national election next year. And in Pakistan, more than 240 protesters have been arrested during nationwide demonstrations demanding the release of former Prime Minister Imran Khan. Authorities say the protests threatened law and order, but supporters call them a push to restore democracy. Coming up in the programme, tariffs turn up the heat on India's gold and jewellery exporters. We'll tell you how the industry is polishing its defences against the duty shock. Stay tuned. Welcome back to Inside India. At least 4 people have died and dozens more are missing in a village in India's northern Himalayan state of Uttarakhand after flash floods triggered a mudslide. At least 70 people have been evacuated as search and rescue operations continue for those who are still trapped. We are counting down to the market open in India. This is how we are shaping up. 24,700 roughly is where we're expected to kick off from, which would represent very little change compared to where we left off yesterday for the benchmark, which was 24,650 roughly. Dollar-rupee exchange rate, some very interesting price action there. Ahead of the RBI, have been quite active in terms of propping up the rupee, which has been on something of a depreciation path given all these global headwinds related to tariffs and the entire narrative with the trade deal over the past week. 87.72.3 is where we stand. Now, India's biggest jeweller, Titan, is exploring moving some manufacturing to the Gulf. The goal? Avoiding steeper US tariffs after President Trump slapped a 25% duty on Indian imports and warned that there's more to come. The Tata Group company is already in talks to buy a majority stake in Dubai's Damas Jewelers for $283 million. Titan's MD says lower duties in the UAE could help keep exports to the US competitive. Gold and jewellery are India's fifth biggest exports to the US, and companies are bracing for impact as new tariffs kick in this week. Let's talk more about this and how Indian jewellery industry is dealing with these headwinds on the ground. Rajesh Mehta joins us now, Executive Chairman at Rajesh Exports, one of the leading Indian exporters of gold products. Sir, what does a 25% tariff mean for your business in terms of impact?
25% tariff on imports to the USA, that is exports for us to the USA, would definitely have of the exports for gems and jewelry from India, because percent tariff would mean equal prices and the value addition both. So because of that, I think the product to the consumer would become too expensive, and it would be very difficult to compete. Primarily, the are not tariffed at 25%. They are less than 25%, and gold being a sensitive, price-sensitive commodity and price-sensitive item, it would make a big difference even if there is a difference of even 2 to 5 or 7% also. So I think it would have a telling effect on the Indian exports and of gems and jewelry. But there are certain items which can be made only in India. So maybe those items would be imported, but there would be a hit on the volume. That's what I feel. And it would be better if the negotiations are completed and if the tariffs come at par with the other countries.
Indeed. Rajesh, it may not be practical for some to do so, but do you think that we will see the larger players in the industry doing what we are hearing Titan is doing and moving some manufacturing to the Gulf?
Shifting the manufacturing, right? That's what you're telling.
Yes, sir.
Yeah, that would be... It would be very difficult to do it on an immediate basis, because this has come, as within a few days. So shifting the manufacturing and all that is going to be time consuming. Whichever company is going to do that. It's not a case wherein you can start the manufacturing in a week or two or anything like that. That is bound to take 3 to 6 months if these tariffs continue, because people will first wait. They will wait and see that if the tariffs continue or the tariffs are withdrawn or something like that, because we have been watching that American statements have been very volatile, and they say one thing today and do something tomorrow. So because of that, I think people will first initially wait to see that if the tariffs like that. If they are not withdrawn, then maybe, and if it looks that it's going to be permanent or something like that, then I think over a period of time, the manufacturing may be shifted. But this being labor intensive, the Indian jewelry is labor intensive. So shifting also is not going to be that easy. But there would be a partial shifting. That's what we feel. But that would be a wait-and-watch scenario. We'll have to wait and see as to how the story or the situation develops as we move forward.
Rajesh, this is deeply problematic for an industry that's already being subjected to a number of hits, right? The Indian gold sector also must deal with rising domestic import duties, surging material costs. How badly, in aggregate, then, is this going to impact margins and profitability across the industry?
it is bound to affect the margins and profits. And as I said, it's being a labor-intensive industry. And also because the gold prices are on a practical all-time high. Gold prices are very high. The demand for gold is in terms of volume, that is in terms of quantity, is not as high as it used to be before. So there would be an impact on the margins because the retail customers are not there with the gold prices, even in the domestic market. And with this tariffs kicking in, etc., there is further pressure on manufacturing. That is, the manufacturing will go down. That would lead to unemployment, and that would lead to, the workers not getting enough work and that kind of a situation, which would have a telling impact on the margins as well.
Could it lead to the smaller to medium-sized?
Also in the other lines of the trade.
Understood. Rajesh, could it lead to these pressures, these multiple pressures on the industry? Could it lead to the smaller and medium-sized artisans, goldsmiths and jewellers being forced into bankruptcy?
There would be not a case of bankruptcy as such, but they would be in distress. There is no doubt about that. The smaller jewelers and the artisans would be in distress because this is not a trade which is, highly dependent on bank finance or anything like that. So there won't be bankruptcy cases or something like that, but there would be a distress. And maybe people would move into artificial jewelry or people would move into other kind of manufacturing activities away from gold and diamonds.
So the festival season is approaching. How much of a positive catalyst could this be for the pricing environment? And do you have any leading insights you can share with us about the demand profile this upcoming festival season?
The upcoming festival, the demand, what we see is of two kinds. One is the domestic and one is the international, what India exports. I feel because of the high gold prices, the demand is already lower. So it is going to be a problem in terms of demand because this will be an additional burden. The tariffs kicking in would be an additional burden. So gold prices being higher, the domestic demand was lower, and now with the tariffs kicking in, the demand would be still lower. And I think we are going to see lower and lower volumes of gold business in India.
Final question, sir. What is your message then to this Indian administration, to the government, and what needs to be reformed in terms of import policy, export incentives, new markets to remain competitive in the longer term, especially given the risk of future shocks?
Yes, I think the government should give some protection to the jewelry manufacturing industry because, as I said, it's highly labor intensive and more than around 2 to 3 million people are dependent on this industry for their livelihood. So government should try and support, lower the duties in India. The import duties must be lowered in India so that there could be some better consumer demand in India. And definitely, of course, it's an international subject, but if something can be done about the tariffs in the U.S., if the tariffs can be brought down, whatever the negotiations are there that can be done, then that would also help. But on the long run, I feel the government needs to support the industry for the sake of the livelihood of millions of artisans and lower the import duty in India.
There's a lot at stake, sir. Thank you very much indeed for joining me. Rajesh Mehta there from Rajesh Exports. Now we are counting down to the market open in Mumbai. We will return with those updates in 2 minutes. Indian markets are in the pre-open. The Nifty 50 is looking like this, 24,641. Rupee continues to be under some pressure against the US dollar. Take a look at bond yields as we wait for the RBI's policy decision. On to some individual moves as well. Shares of Adani Ports are looking like this. The Indian port operator and logistics company posted a 6.5% jump in quarterly net profit thanks to rising cargo volumes. Adani Ports highlighted that its Israeli port operations were unhampered despite the Israeli-Iran conflict in June. Staying on earnings, we are watching shares of Bharti Airtel. Growth in user base and last year's price hikes boosted the Indian telco's quarterly profits by 43%. Airtel posted domestic user growth of 6.6% in Q1. Remember, the company's digital arm recently unveiled a new cloud platform providing AI solutions for businesses and telecom operators. In the pharma space, Lupin reporting a 52% rise in net profit driven by strong domestic and US sales. Lupin's US sales saw 24% annual growth in the last quarter. But those numbers could get a hit soon as President Trump says he's planning to impose duties on separate classes that were exempt from reciprocal tariffs, including electronics, semiconductors, steel and pharma.
On pharmaceuticals, we'll be putting a initially small tariff on pharmaceuticals, but in 1 year,
President
1.5 years maximum, it's going to go to 150%, and then it's going to go to 250%, because we want pharmaceuticals made in our country.
Let's bring in Feroz Aziz now, Deputy CEO at Anand Rathi Wealth. Feroz, thank you for joining me. So, given 25% tariffs look as though they're going to stick, how would you characterize the balance of risks in the Indian markets, and how does all of this change the narrative for you?
Good morning, Sri. If you look at what Mr. Trump says, I personally think that's a negotiation tactic. There are two, of course, there is going to be tariffs, but the relative differential of tariff for commodities or items we export to US, which is 18% of India's exports are to the US, which is almost $81 billion of goods. I personally think that this is a negotiation tactic, and the differential tariff is going to be determining the impact on industry. And I think when we're speaking of capital markets, the impact is going to be very different, because the industries which get impacted, like I was hearing Rajesh from Rajesh Exports when I was on the waiting line, the representation of several industries in the top 500 NSE 500 of India are reasonably low. The corporate profitability, because of this change, if the tariffs were supposed to be higher than they currently are stated, would be 1% dent on the growth which we expect for this year and the next year. So that will not change the capital market. So coming back to your pointed question, I personally think Trump is trying to crack one large economy so that his leverage with negotiation of the rest of them happens. But to his surprise, capital markets are not reacting to his tweets. And that is a strong reason why. And I could probably, in the latter part of the interview, I could probably tell you what are the 7 reasons why the markets don't seem to be correcting to the surprise of the president.
Feroz, what are you expecting from the RBI? And do they need to perhaps go for another 25 basis point cut? Well, they went by 50 last time. But do you think that they need to deepen those cuts, given the balance of risks now on the external front, which seem to be getting worse?
I think from a repo rate correction from 6.5 to 5.5, we had actually started the upward interest cycle from June 2022. And Feb 2025 is when we saw the first rate cut. And then we've already seen 1% of repo rate reduction from 6.5 to 5.5. And the more important one was the CRR rate reduction, which actually infused 2.5 lakh or 2.5 trillion rupees of liquidity. So I personally think RBI has done enough for this financial year, point one. Point two, I personally think that the yield curve, which had become flat in India, which was the biggest challenge for banks, which represent the largest weight in Nifty and in NSE 500, the problem was a flat yield curve had created a larger problem in the deposit growth. I think that yield curve has come back with at least 82 bips between repo or the 1 year FD rates and the 10-year, 5-year FD rates are now diverging at least 50 bips. So coming back to your point, I don't think RBI needs to do much. If they will psychologically want to do it at this time because of what is happening externally, could be a surprise. But I wouldn't expect a rate cut at this stage. But latter part of this year, I'm sure, because inflation came down to 2.1%, significantly lower than the 4% they've been targeting. And that's the multi-year low. Almost about a couple of years back, we had seen the CPI number there. Of course, it's not the holistic inflation, but that is one of the lowest numbers you've seen. RBI has headroom, has amazing reserves to handle the rupee depreciation if there's an impact on the goods. So I personally I don't think they will jump the gun and reduce the rates. I'd be happy if they did. That'll have a super positive impact on the equity markets to nullify all the trade war talk, which has gone for a week.
Exactly. Feroz, you touched on the exchange rate there. That really seems to be the transmission mechanism, doesn't it, of all this angst, if you will, and external headwinds and that ricocheting into the growth trajectory in India. Do you think that the RBI has got control of the rupee and the depreciation path, or is there a risk it could surpass those record lows that we saw in February?
Yes, see, record lows for a country which has a higher interest rate is fait accompli, right? You would depreciate to the extent of the interest rate differential as per interest rate parity. But we've done better than interest rate parity's implied depreciations. If you look at the 15-year rupee depreciation is about 3.5%, 1% dollar index has appreciated. That means we have depreciated 2.5 relative to the rest of the currencies relative to dollar. So point I'm trying to get to is I think we are very well poised today than 3 years back with our dollar reserves to keep the currency depreciating equal to the interest rate differential. But the interest rate differential itself has narrowed, which is a great news in the long term for dollar because US 10-year paper is quoting at 4.3, 4.4, 30-year paper is at 4.9, India's 10-year paper is at 6.3. This is the lowest spread between 10-year yield of Fed and RBI or government paper in India. So I think the long-term rupee depreciation will come down. And the last 15 years, there could have been a 3.5% depreciation. But the next 10 years will not see more than 1.5%, 2% depreciation because they're not able to solve their inflation problem and they're not able to reduce interest rates. But India is comfortable there. I personally think rupee, I'm not too worried. Of course, short term, like you rightly said, if my exports fall from 81 and go back to 2022 levels, because $15 billion out of the 81 is exempt, the rest of it is not exempt, and that's 25% tariff. That will create an impact. How much will it create impact? Will it set me back to 2023 levels of goods export to US, or 22 will depend on the relative tariff between other countries, like if gems and jewelries, if there is another competing country, what is the relative tariff will determine whether I go back to 2022 levels or 2023 levels. But my trade deficit or trade surplus is $42 billion from whichever country's perspective you see. That went up from almost about 23, 24, 10 years back. So that's what is pinching US. And I think it's more of negotiation. And relative impact on corporate profitability is negligible. And the liquidity in India, almost getting $3 billion from domestic retail, is going to be the key. And we almost one last point.
Let's hope so, right? And let's hope that US-India relations haven't been irreparably damaged. And maybe there can be some room to maneuver and some positive developments when the US negotiating team, as I understand it, are in India later this month, August the 25th, and we can see some headway there. In terms of the sectors most at risk in this market for us, it seems to be pharma, it seems to be IT services. How are you approaching those areas?
Yes, you're absolutely right. I'm not too worried about IT. IT is something which has not been, it's not, in India, the IT has never been a product industry. It's been a service industry. And cheap Indian-speaking outsourcing can't be replaced so easily by US firms. So I personally think that our Indian IT has not pitched for innovation so much, but they've had immense agility. And we have to give it to them for having survived so many different cycles of evolution of the industry. And I think IT is poised for doing that. But what worries me is definitely pharma, especially the clip you paid, 250% tariffs. Of course, that could be a little exaggerated. Actually, Charles Munger had said in 2011, if Trump became president, I would hate it because he's He's quite puffery. So I personally think that is an exaggerated negotiation tactic of what he just said. But fortunately for us, the pharma industry in NSE 500, which is what all Indian mutual funds and foreign investors invest in when it comes to capital markets, is as little as 4% weight. That's the key. All the top weights, see, the top weight for Nifty is 24% of banks. Banks completely are inward looking, not outward looking. So I personally think there will be impacts on industry. Sectors will get impacted. Fund managers who have gone really bullish on certain sectors will have large volatility, high betas to live with for the next 3, 4, 5 months. But I'm not too worried about pharma from a capital market standpoint if you look at diversified portfolios. But certainly, like you rightly pointed out, that's one very volatile sector, which was supposed to be defensive, has been turned into a high beta sector lately.
Feroz, banks, financials, do they remain a good place to be?
Yes, Sri, like you asking this question, I personally think banks remain because they are 2 sigma lower than their long-term averages in terms of P or PB from a valuation standpoint. Indian markets are just 6% away from the peak, like S&P 500 is also not too far from its peak. We have had a 9-10 months time correction, but Indian banks, which is the largest portion, have already gone through that struggle because of the flat yield curve. An Indian, like my dad, when it goes to an Indian bank, if he gets the same interest rate for a 1-year deposit and a 5-year deposit, not even in his wildest dream, he would choose 5-year deposit. That's why 1-year deposits were being rolled over very lacklusterly. That has got solved, and I am very bullish on Indian banks and how they've managed their NPAs during the last couple of years. During the wars and the geopolitical uncertainties. I think a Nifty bank can beat Nifty by about 3-4% compounded for the next 3 years.
And Feroz, finally, how do you feel about the consumer plays in the market? And arguably, we have been getting some mixed signals with regard to hospitality and online shopping and this entire quick commerce narrative and whether that's been overdone or not.
You're right. You're so right. And if I have to substantiate that with another sector's consumption, which is the auto sector, you saw that Nifty auto degrew by about 2.6% in earnings last year. And this quarter, it's been okay. But consumerism in India has taken some little break. But one thing structurally which Indian government has done from 2021, which is what is creating that consumption boom, is leaving more money in the hands of the taxpayer. Earlier, there were a lot of compulsory investments to save tax in India to make sure that the fiscal deficit of Indian government would be funded because foreigners were not buying Indian bonds. We were not even investment grade. So Indian foreigners would buy Indian equity, Indian households would buy Indian debt. That was the model. Now that we're comfortable with our fiscal deficit, what government in 2021 did was said that take all your money and invest where you wish to. That's why the equity cult started building and we got 15 trillion.
Feroz, it's always great catching up with you. Really comprehensive insights. Thank you, sir. Feroz Aziz there from Anand Rathi Wealth. All the time that we have today on Inside India. Do keep watching CNBC. Access Middle East is up next.